So in this lesson, we want to continue our discussion on financial instruments. We've already looked at the introduction to financial instruments. What is the meaning of financial instruments? We look at the definition of the various types of financial instruments, where we lay emphasis that when we talk about financial instruments, it's actually a contract that gives rise to two things. It gives rise to financial assets of one entity and financial liability of another entity. We've looked at that in our previous video. We also look at how to recognize a financial instrument in the books of the entity, and we even solve some practical questions to augment our understanding on the recognition of financial instruments. Today we are proceeding, like I said in our previous video, that we are going to take each of the financial instruments one by one and extensively look at what goes into each of them. So in this lesson, we are going to focus on one type or one classification of financial instruments, and that is going to be financial liability. So if you've not watched the video on the introduction aspect, the definition and the recognition of financial instruments, you can kindly do so on the channel. The video is on the channel. So as indicated, we are looking at financial instruments. And like I indicated last time, we said that when we talk about financial instruments, we are saying that it gives rise to financial assets of one entity and financial liability of another entity. In the previous lesson, we've extensively looked at what is financial asset and what is a financial liability. And even sometimes we said, or equity instrument. And we have also looked at the difference between equity instrument and a financial liability. Today we are going to take financial liability, look at the various types of financial liability and how to measure those various types of financial liability. I indicated that for you to be able to appropriately measure your financial instruments, then you barely have to also understand how to classify your financial instrument. The classification is very important if you really want to get the measurement correct. So how to classify financial instruments starts from each definition. You barely have to know the definition of each types of financial instrument before you can be able to classify them. So I said that if you want to determine a financial instrument from financial assets and financial liability, you want to distinguish between financial assets and financial liabilities, nothing by the choice of words, what the entity is doing. So when it comes to financial assets, you see that invest. If the entity is investing, if the entity is acquiring, if the entity is buying, if the entity has purchased something, purchased an instrument, then we are looking at a financial asset category. On the other hand, if you see issued or sold, then we are saying that such financial instrument should be accounted as a financial liability. Notwithstanding, we have one type of financial instrument that is not captured in the definition I indicated in our previous lesson to be compound instrument. So right after financial liability, we are going to look at what is a compound instrument, how we account for compound instrument before we proceed to look at what is a financial liability. So without wasting my time, let's dive into the topic for the day. Please do not forget to subscribe, like, and share our video so that we can increase the learning community and widen the learning environment. So we want to basically look at financial liability, and financial liability can be classified into two different broad types. When we talk about financial liability, let me bring it here. So when we talk about financial liability, we are saying that it can be classified as a financial liability that is measured at fair value, through profit or loss account, or financial liability that is measured at fair value at amortized cost. That is measured at amortized cost. We can say that's measured at amortized cost. So we have basically two classifications of financial liability. Anytime we take a financial liability, we have basically two classifications. Most importantly, one thing you're supposed to note is that most financial liabilities are classified at the amortized cost. At the amortized cost. Now take note of this. Take note of this. If we have a financial liability that each treatment or each recognition is supposed to be held at amortized cost, but such recognition will bring an accounting mismatch. Such treatment will bring an accounting mismatch. Then the entity can make an irrecoverable designation and irrevocable designation of that instrument to be classified as a financial liability, that is fair value through profit or loss. This statement I have mentioned or I've stated is kind of broad, so I need to elaborate. Now, how will you know that in the question in front of you, in the instrument presented to you is supposed to be classified as fair value through profit or loss, or is supposed to be measured at amortized cost? How will you know in the question? Now, mostly when the financial liability is held to maturity, the purpose of the instrument, the purpose of the liability, the financial liability is supposed to be held to maturity. Then we are saying that it's supposed to be measured or classified as amortized cost. So when the financial liability is going to be held to maturity, that means it's having a redemption period, is having a termination period. So for instance, A is issuing a bond, and this bond is for 5 years period or 5-year period. This is a financial liability because it's issuing and it's having a maturity date. For this purpose, we are going to refer to this as, or we are going to measure this automatically at fair value at amortized cost. So anytime the financial liability do not have a maturity date, anytime the financial liability do not have a maturity date, then automatically we are going to classify it at fair value through profit or loss account. Exception. There are some times where an entity, or in fact, an entity will issue a financial liability which will be having a maturity period. It will be having a redemption period. For that matter, it's supposed to be what? Classified as fair value through amortized cost. But if the entity treats such an financial instrument as such, it's going to bring an accounting mismatch. The thing is supposed to be classified as a financial liability, which is fair value at amortized cost. It has met all the criteria for which it's supposed to be classified as such. But if the entity account for that instrument as such, is going to bring an accounting mismatch. Such clauses will be stated in the question, or it will be stated in the contract. If that's the case, then the entity must make an irrevocable designation of that instrument. That irrevocable designation that that instrument, although it's supposed to be measured or classified as fair value at amortized cost, because it's going to bring an accounting mismatch, although it's supposed to be measured like that, but it will bring an accounting mismatch. The entity must irrevocably designate that instrument as a financial liability, which is fair value through profit or loss account. Kindly take note of that. So under normal circumstances, we have two classes of financial liability. Financial liability, fair value through profit or loss, or financial liability, which is measured at amortized cost. And we have looked at situations where, although it is meeting the classification of financial liability to be classified at amortized cost, although it's meeting such conditions, we will still have to irrevocably designate it as a financial liability measured through profit or loss account. Now, having understood the classification of this of financial liability, we can proceed to look at how we are going to measure each of them. Because if you don't know how to classify them, when you are given a question, let's assume the question is supposed to be classified at fair value through profit or loss, and you want to classify it at amortized cost, and you apply the amortization measurement to measure it. At the end of the day, your answer or your calculations or treatment, everything is going to be wrong. So like I indicated, the classification is very important when it comes to financial instruments. Having know how to classify the financial liability, then we now want to proceed to look at how we will measure it. Now measurement, like I indicated, we have initial measurement, we also have subsequent measurement. Initial measurement, subsequent measurement. How do we initially measure financial liability, which is fair value through profit or loss account? So we are looking at the initial measurement. Initial measurement of financial liability, fair value through profit or loss account. So initially, a financial liability which is measured at fair value through profit or loss account, which is classified as financial liability, fair value through profit or loss account, should be initially measured at its fair value. Should be initially measured at its fair value, which is going to be the nominal value. The nominal value. The nominal value. So let's say that an entity is issuing $100,000 2% bond. That 100,000 there is the fair value. That 100,000 there is the fair value. Let me pass this caveat. It's not always the case, especially at the strategic business reporting level or corporate reporting level. It's not always the case that you will be given the fair value. Sometimes you will not be given the fair value, and you must apply the provisions under IFRS 13 fair value measurement to ascertain the fair value of the instrument. So it's not always the case that you'll be given the initial value of the instrument. Sometimes you need to use the provisions of IFRS 13 to ascertain the fair value of the instrument. If there is any transaction cost are costs the parties will not incur if they don't go and enter into that transaction. So we call it incremental cost. They are avoidable costs. They are costs that an entity will avoid if they don't enter into such, contract. So they are incremental costs. So if an entity incurs such a cost, but that financial liability is measured at fair value through profit or loss, or is classified as fair value through profit or loss, then that transaction cost in the question must be treated as an expense in the profit or loss account. That transaction cost must be treated as an expense in the profit or loss account. It must not be capitalized on the fair value. Once again, if there is a discount, the entity is giving discount because it's the one issuing, is requesting that the investors will come and invest. So for that matter, is giving discount on the initial value of the instrument. If that is the case also, that discount should also be treated just as your transaction cost. So that will also be treated as an expense. So that is the initial measurement of the financial liability fair value through profit or loss account. How do we initially measure financial liability fair valued at amortized cost? If that's the case, the initial measurement of such is supposed to be measured at the initial fair value, the fair value of the instrument. In that case, I said is the nominal value. But in this case, if there is a transaction cost, you see this is a transaction cost being incurred by the entity, we are supposed to reduce it. So here we are going to less transaction cost if there is any, and if there is any discount also, you will less that discount. So you see, even with the initial measurement, how you will initially measure a financial liability fair valued at amortized cost is different from how you measure instruments that are fair valued through profit or loss, financial liability that are fair valued through profit or loss. How you initially measure them is different. So if you wrongly classify them, then your measurement will also be wrong. That is why I'm laying emphasis on the fact that the classification is important when it comes to the measurement of the instrument. Classification is important when it comes to the measurement of the instrument. All right, having understood how to initially measure our financial liability, fair value through profit or loss, and at amortized cost, how do we subsequently measure them? How do we subsequently? If we hold such an instrument till the reporting date, you see, those instruments will be in your books till the reporting date. If that is the case, at the reporting date, what value will you attach to them? Will you still attach the original value you have accounted for, you have accounted for them? Will you attach the same original value, the initial measurement value to them at the reporting date, or you are going to attach a different value to them? That has to do with the subsequent measurement. Now let's take the first one, which is financial liability, fair value through profit or loss. How do we subsequently measure it? How do we subsequently measure it? So let me clean the initial measurement and present the subsequent measurement here. So subsequent measurement, what we do is that you will ascertain the closing fair value. The closing fair value. Already, you know the opening fair value. That will be your that will be the initial measurement of your financial liability, fair value through profit or loss. The opening will be that one. Now you compare the closing with the opening and see whether there's a gain or loss. If there is a gain or loss, so we call it fair value gain or loss on the instrument. We will send this to the profit or loss account. This will go to the profit or loss account. That is why it is called fair value through profit or loss account. Any gain or loss as a result of fair valuation will be treated in the profit or loss account. Now, how do we ascertain whether there's a gain, or how do we ascertain whether there is a loss? This is how we do it. This is a financial liability. So anytime the value of the instrument is increasing, then it is a loss to us, because we are going to pay more than we are required to pay. But if it is reducing, that is a gain to us, because we are going to pay, the entity is going to pay less of the instrument with the entity. Okay, so we said that there is a gain if the closing fair value is lesser than the opening fair value. There's a gain if the closing fair value is lesser than the opening fair value, and there is a loss. There is a loss if the closing fair value is greater than the opening fair value. Because this is a liability, just take it from this perspective. If I'm owing, in fact, let's assume entity A is owing entity B, and at the end of the period, at the beginning of the period, the value is $100. Now, at the end of the period, the value has increased to 1,000. 1,000. You see, this is a loss to me because of the increment. So anytime your closing balance is higher than the opening balance, then that becomes a loss to the entity. Now, be vigilant. Sometimes we may have 3 years or 4 years of a financial liability, that is fair value through profit or loss. So let's assume we are dealing with 2020, 2021, and then 2022. Now you'll be given the closing fair values. You'll be given the closing fair values in the question most times. If it's not given to you, they are going to apply the provisions in IFRS 13. I have a video on it on the channel. You can have a look. You have a watch of it, and then you understand the provisions of IFRS 13. So you have to get the provisions of IFRS 13 to ascertain the closing fair values. But most instances at the financial reporting level, you will be provided with the closing fair value. So assuming the closing fair value here is 1,000, here is 800, and this place is 700, and then our opening fair value, the initial money, the initial value that we calculated, like I indicated in that example, is 100. Is 100 over here. Okay. Now we don't know the opening for year 2021, but remember that the closing of 2020 will become the opening of what? 2021. So in this case, the opening here is going to be what? It's going to be the 1,000 over here. Now the opening here will be the closing of this one. So this one will be what? The 800 over here. Now we can now compare these two to ascertain our fair value gain or our fair value loss. So how do we do that? So this is going to be gain or loss. So gain will be in will be a positive figure, and then the losses will be in the bracket. So here, because the closing is higher than this, there will be a loss of 900. But if you come, you can see that our opening is higher than this, so there's a gain of 200. And here also, you can see that this our closing is lesser, so there is going to be a gain of again, so not supposed to be in bracket. So this also there is going to be a gain of 100, a gain of 100. So this is how we ascertain the gain or loss, in fact, fair value gain or loss on financial instruments that are fair valued through profit or loss account. Now let's look at situations, the subsequent measurement of financial liability, which are measured at amortized cost. How do we subsequently measure financial liability, which are measured at amortized cost? From the name. So subsequently, financial liability, which has measured at amortized cost, subsequently we amortize them. So the subsequent measurement of such instruments are subsequently what? Amortized. They are subsequently amortized. And here, when you amortize, I have how to prepare an amortization schedule on the channel. You can have a look at how to do that. Now, if you're amortizing, this is the table. So we have the year over here, and then we have our opening balance, which is going to be the initial measurement. So opening balance. Then you have our finance cost. Because it's a financial liability, you call it finance cost. When you get to financial assets, you call it finance income. This the table I'm presenting on the board is of the view that the payment of the interest is done in arrears. Payment of the interest is done in arrears. If you want to know more about how to prepare this amortization table when the payment is done in advance, you can watch my lessons on leases, where I've treated how to account for payment in advance amortization schedule. Payment in advance amortization schedule. You can watch my videos on leases and you will ascertain that understanding. Now, so this is a finance cost here. Mostly we use the effective interest rate. We use the effective interest rate. And then this is going to be our cash payment. And then we will now get our closing the closing balance. Now, our finance cost will go to our profit or loss account as an expense. Our cash payment will go to the statement of cash flow as cash payment, and then our closing balances will go to our statement of financial position. Our closing balances will go to the statement of financial position. Now, let me teach you this. Very, very important. Now, we said that one basic feature of financial liability, which is measured at amortized cost, is that it's going to have a redemption date. It's going to have a maturity date. Let's take, for instance, in this question, you're having 3 years maturity date. 3 years maturity date. What it simply means is that at the end of year 3, the entity which has issued the loan note or the bond or the financial liability instrument will pay the principal plus the interest at the end of year 3. Now that principal that the entity is going to pay, the investor can redeem it at premium, the investor can redeem it at par, or the investor can redeem it at what? At discount. And how it is being redeemed will depend on how you will treat the final cash payment over here. I've extensively looked at this on amortization schedule, and the lesson is on the channel. You can have a watch of it to understand that thoroughly. But I'm still going to repeat it over here. So let's assume that the investor is going to redeem the instrument at par. What it means is that the opening value, the coupon, the nominal value of the instrument will be the same here. So here, let's assume the nominal value is 100 with 10% interest, nominal coupon value. The coupon interest rate is different from the effective interest rate. So in most cases, you'll be given 2 interest rates. One will be coupon rate, which comes with what? The nominal value, and then one will be effective interest, which we are going to use for the finance cost. All right. So the interest here will be 10. The interest here will also be 10. Now, if the instrument is redeemed at par, that means that here will be 10 plus the nominal value. Nothing will be done. The nominal value will be the same at the date that it will be redeemed. However, if it is at a discount, then this nominal value here must be reduced. Let's say it's at a discount of 5%. Let's say at a discount of 5%, or sometimes they will give you the value. If it's at a discount of 5%, then we are going to charge the 5% on the nominal value of 100, which is going to give us 5. When we come here, we are going to treat only 95 as the redemption value because the investor is redeeming that at a premium. Let's take it that it is going to be redeemed at a premium, then that 5 will be added rather instead of less than. If it's premium, we are going to add the 5 to the nominal value, which is going to make it 105. So you have to be careful about how we treat the last day figure. You have to check how the investor is redeeming the financial liability. Is it being redeemed at par? Is it being redeemed at premium? Is it being redeemed at discount? And remember that how it is being redeemed will affect the final figures over here. So basically, this is all about financial liability. What is left is for us to take one practical question and we will go through thoroughly and see how we will treat it. Remember that this is just calculation. When you are done, you need to present them. That's why I have written here. These figures, we will send them to profit or loss, while this one, we will send them to statement of cash flow, and this one, we will send them to statement of financial position. Now, how do we ascertain this? Now, this is your opening balance. These ones are less. So we add the finance cost, we add it to our opening balance, and then we less our cash payment to get the closing balance. So if this is A, this is B, for you to get this one, it is A plus B minus C. This is, let's say this is C minus C. That will give us D. So we add this to this, and we less this one to get what? To get D. So this is how we account for financial liability, which is measured at what? At amortized cost. So now we can take a practical question to augment all that I've said so far. So let's look at the question on the screen. On 1st January 2021, James issued a loan note with 50,000 nominal value. So you see, this nominal value has been stated for you. So the nominal value in the question is $50,000. It was issued at a discount of 16%. So here, it was issued at a discount of 16%. Issued at a discount of 16%. Then, the cost of issue were $2,000. The cost of issue were $2,000. Now, interest of 5% of the nominal value is payable annually in arrears. So you can see this is our coupon rate, or our nominal rate of 5% is going to be paid. This is going to be our cash payment. Let's see if you get an effective interest rate in the question. The bond must be redeemed on 1st January 2026 after 5 years. So here, the maturity date is 5 years. The maturity date is 5 years. And then the effective rate of interest is 12% given to us in the question per year. How will this be reported in the financial statement of James over the period to redemption? So from the very first day to redemption, how are we going to account for such an instrument? First of all, we need to ascertain, or we need to classify it, or we need to check whether we can classify such an instrument as financial asset or a financial liability. And from the word go issued, it's a James issued, so automatically that becomes a financial liability. The next thing is it going to be classified at fair value through profit or loss, or is it going to be classified at amortized cost? Let's look at the situations in the question, the clauses in the question. Is it going to be redeemed after a defined period? And that question is yes. They said after 5 years, the bond will be redeemed after 5 years. That means it's having a maturity date, so automatically that is a financial liability measured at amortized cost. So we need to apply all the principles of measured at amortized cost for this particular instrument. So it is a financial liability. measured at amortized cost. That would be the instrument in question. So for this matter, we are going to look at initial measurement. So let's have our initial measurement. So our initial measurement, first of all, what is our nominal value? Our nominal value in the question is $50,000. Was there any transaction cost in the question? Yes, there was a transaction cost of what? Of 2,000. So don't forget how we treated the transaction cost. We said that transaction cost will be less. So transaction cost of 2,000 will be less. Is there any discount? Yes, there was a discount of 16%. Now you need to be careful about this discount. This discount is an issued discount, not redeemed discount. So anytime you have such a question, you will be informed as to whether it is a redeemed discount or an issued discount. In this question here is a issue discount of 16% on the nominal value. So here our discount is going to be 50,000 times the 16%. All right, so 50,000 times 16% is giving us 8,000. 8,000. So we take this out of this to get 40,000. So this becomes the initial value of our financial liability measured at amortized cost. Now we need to look at the subsequent measurement, which is say we are going to what? Subsequently what? Amortize it. So subsequent measurement. So we are going to amortize it. So subsequent measurement. So remember the table. The payment is in arrears, so it's going to follow this format. So we have the year, then we have our opening balance, then we have our finance cost over here. Then we have our cash payment, and then we will have our closing balance over here. Okay. All right. So here we are looking at year 1, year 2, year 3, year 4, and then year 5. So 5 years. 5 years. So what is our opening balance here? It's 40,000. Don't forget our finance cost in the question is 12%, and our cash payment is 5%. Don't forget all figures are in dollars. So 12% is our effective interest rate, and then this is our 5%. It will be the same throughout. So we will charge 5% on the nominal value of what? 50,000, and that is going to give us, if it's 10%, it will give us 5,000. So that's going to give us 2,500. So 2,500 here is cash payment. You will list it 2,500 here is cash payment. 2,500 here. Another cash payment. 2,500 here. Another cash payment. But the last year, don't forget the last year we are going to what? Pay the liability to the investor, the money to the investor. This is where you have to ask yourself: is it redeemed at par? Is it redeemed at premium, or is it redeemed at a discount? And if you look at the question carefully, they said it's redeemed at a premium of 4,611. So for that matter, we must add that 4,611 to the 50,000 plus the interest that you pay in the last year. So the last year here is going to be 2,500 plus the nominal value of 50,000 plus our redeemed value of 4,611. All these must be less. So that here, because we paid the loan, the last column must be what? Must be dashed. We must not get anything here because we are paying our debt. When we talk about these bonds, it's just a matter of you issuing paper, you giving paper out to people to indicate that they have given money to you. That is all the nature of this loan stuff. If you want to take a long-term loan from the bank, it's just a matter of presenting documents that shows that you've taken loan from the bank. They will give you money. The same thing applies to debenture. The same thing applies to bonds. So they are liabilities. So at the end of the day, you will now take the paper back and pay back what their money they have invested in you. That is all the idea about these loan tabs. All right, let's start with our computation. The first year is going to be 40,000 times what? Times 12. So 0.12 times what? 40,000. And that's giving us 48,000. 48,000. 48,000 in this question. 48,000. Then we add it to this and we less our 2,500. So 48,000 plus 40,000 minus 2,500. So our closing balance in year 1 is going to be 85,500. Then that becomes our opening balance in year 2, 85,500. Then we charge the same 12% on the 85,500. We are getting 10,000. This is supposed to be, oh no, 12% of this is supposed to be, please wait. So 40,000 times 0.12% is 4,800 rather. So plus 40,000 minus 2,500. That is 42,300. 42,300. All right, 42,300. So, all right. So we are charging the 12% on that, which is giving us 50,076. We add it to this and less this one. So plus 42,300 minus 2,500, and that is giving us 44,876. That becomes the opening in year 3. 44,876. And then we charge our 12% on it again, and that is giving us 53,885. So we add it to this and we less this one. So 53 plus 44,876. Then we less the 2,500, and that's giving us 47,761. Remember, that becomes the opening in year 4. 47,761, and we charge again the 12% on this to give us 57,731. So we add it again to our 47,761, and then we less 2,500 to give us a closing balance of 50,992. Then here we are going to have the opening here of 50,992. Again, we charge the 12% on that figure to give us $6,119. Now, if we add this and then less this, it should give us dash. So let's do that. So this plus 50,992 is giving us 57,111. Now let's add this and see if you get the same thing. 2,500 plus 54,611, and that is giving us the same figure. So if you let this from this, you are going to get a dash over here. So that is basically about the financial liability fair value through amortized cost. With the through profit or loss, I elaborated or I illustrated some practical example earlier. Okay, so we are going to take a question on that particular one. Now what is left is presentation. So the initial measurement, you have received cash. So you have received cash over here. So how much cash have you received? You need to account for it. So let's see how we are going to do the initial measurement. So we are going to debit cash, the initial measurement. So let's have our credit and debit here. So we will debit cash of 50,000. That's what you have received. No, you didn't receive. You received actually cash of 40,000. Okay, so you receive cash of 40,000, and then you debit transaction cost. It's an expense, so it's have a debit balance of 2,000, and then you also debit your discount. It's also having an expense. Then we will credit what we call liability. You credit liability of 50,000. This is going to be our initial measurement. Then subsequently, don't forget, this will go to statement of profit or loss. This will go to our statement of cash flow, and this will go to our statement of financial position. So let's bring them here. So let's first have our statement of profit or loss. Since this is just an aspect of it, we are going to bring extract over here. So we have 2021, 2022, 2023, 2024, and then 2025. So I can clean this side. Okay. Then we have our dollar sign at the top. So here, don't forget our finance cost is going there. So finance costs. So year 1 was 4,800. Year 2 was 5,776. Year 3 is 5,385. Year 4 was 5,731. And then the last year was 6,119. Then we go to our statement of financial position. Statement of financial position, also extracts for that matter, because it's not a full account. Here we are going to present our closing balances in the statement of financial position. Once again, we have years 2021 to 2025. Now with the financial liability, we need to split it into current financial liability and the non-current financial liability. So we have what we call non-current financial liability. So non-current liability, and then we also have what we call current liability. So here we are going to have our, in all cases, it's going to be financial liability. Now, if you take this closing balance, it will take you more than 1 year to pay. This will take you more than 1 year to pay. This will take you more than 1 year to pay. But this one is just 1 year. So in all cases, only this one will be current liability and all the rest will be non-current. So the year 4, 2024 is going to be 50,992 to be current. Now years 1, which is 42,300, 44,876 for year 2, and then year 3 is 47,761 will all be non-current. And then the last year, since we are paying the amount, it should be out of our books. Okay, now let's look at how you will do with the statement of cash flow. I'm presenting that at the down here. Statement of cash flow or cash flow statement. Statement of cash flow. So here again we have 2021, 2022, 2023, 2024, and then 2025. All is in dollars. They are all in dollars. So this is going to be our cash payment. So year 1 is 2,500. Since it's cash payment, you can ignore to bring it in bracket. This is also an expense here. This one finance cost an expense. Okay. So we said cash payment, so we can ignore to bring it into brackets. This will also be 2,500. Year 3, 2,500. Year 4, 2,500. And then year 5, you paid the whole amount, which is going to be the 57,111. So that is going to be the presentation from the calculations we've done. So these are the calculations and these are the presentations over here. For you to, get all your full marks, always remember that when you're done with your calculations, you have to present. When you're done with your calculations, you have to present. So that is it for financial liability. Don't forget, in our next lesson or next video, we are going to take compound instrument. And after that, we take financial liability. We have already looked at the introduction aspect. So we are proceeding with each of the classification of the financial instrument with a particular video. We are doing this to establish our understanding so that we don't, add all of them in one lesson to make the, video long and difficult to watch. Okay. All right. So do not forget to subscribe, share our videos with others if you've not done so, to increase the learning community. Thank you.